How's it going, everyone? In this video, I'm going to teach you about institutional levels and why you should stop using standard order blocks. Now, there is a big difference between a standard order block, supply or demand level. There's multiple terminology for it, but I want you to start seeing institutional levels with these four mechanical criteria. This is one of the biggest mistakes that SMC and ICT traders make when marking out order blocks. It's just marking out the first and obvious order block that they see, but you need to start training yourself to see the high probability institutional levels. In this example of the mind graph that I've drawn out over here, the difference between a standard order block and an institutional level is that an institutional level must create a break of structure or a change of character. The institutional level must be unmitigated, meaning price must have not previously visited that zone. An institutional level needs to have a liquidity build-up, whether that is double bottom liquidity resting above or below that supply or demand zone to sweep into that higher time frame POI to then start going long from there and following your contextual structural story. And number 4, an institutional level needs to create an inefficient or fair value gap push. As we've discussed in previous videos of this MMFunded YouTube ICT Mentorship, there is an entire separate video on high probability fair value gaps, imbalances, and inefficient push. So there's multiple terms for different fair value gaps. That can be an FVG, which stands for fair value gap, inefficient push, or an imbalance. At the end of the day, they all mean the same thing. Now, an institutional level needs to create a fair value gap or an imbalance resting above or below the supply or demand zone with the liquidity to sweep into this level to then continue long and target your relative structural weak highs or weak lows. Once you start to apply the ideology of institutional levels with your 3 structured types and your contextual understanding of the market, which is what the 3 structural types will naturally give you going into session every single morning, you will formulate a highly effective and profitable system for yourself. Let's go over 1 or 2 live examples. Alright, so if we have to do a quick top-down analysis on Euro USD, it will give you a good understanding of our institutional levels versus standard supply and demand zones. With the understanding of your mechanical structural story and context of what price is doing. And again, that's the second biggest mistake that all ICT and SMC traders make, and is why that 90% of them aren't profitable, is because they want something really easy. They want something that doesn't look at the context of the market. For example, an immediate sweep of liquidity in the London kill zone, fair value gap displacement targeting a 2R. Trading with a system like that is going to be really ineffective. Progress is going to be slow. You may be profitable, but your progress in the long term, such as percentage and equity returns on your account, is going to be very slow. Once you start to understand the higher time frame contextual and structural understanding of the market, it will allow you to catch massive 1 to 10, 1 to 20, even up to 1 to 100 risk to reward trades, like I've been doing over and over again with my members on stream this and last week as well. So we've all understood, and all of my members have the clear breakdown of this and where we can expect Euro USD to go. So most recently on Euro USD, we've had our weekly break of structure to the downside, as well as the daily swing break of structure to the downside and the internal breaks to the downside. So we all understood price is due for a bit of a pullback phase, as after every break of structure, price is due for a pullback. Break of structure, due for a pullback. Break of structure, due for a pullback. Price will never move to a point in one direction. It will follow by means of order flow and your structural story by collecting liquidity, fuel in the market to move in the direction that it's already going to go, and fulfilling orders and where the money lies in the market by mitigating institutional levels or institutional supply and demand zones. Alright, so if we have a look at our daily swing structure, we'll backtrack to this previous structural swing range and we'll use the examples as I take you through it. Now, in order to identify your institutional levels, you need to first identify your structural context and story of the market. So if we backtrack on Euro USD, this will help you out in identifying your institutional levels. As of December specifically mid-December 2022, EURUSD created a daily break of structure to the upside. Now, in order to identify that strong low, we need to look at the lowest point of the pullback after the previous break of structure that created this next break of structure. So over here, we had a break of structure, pullback, created a new week high, and we targeted that week high. Therefore, this was the lowest point of the pullback after the previous break of structure that created the next break of structure. Okay, so here we had daily break of structure, daily pullback with that internal break of structure to the downside. And this is where the difference between institutional levels and supply and demand zones come into place. Okay, so if we have a look over here, we had a valid demand zone over here. We had a valid supply zone over here. We had another valid supply zone over here, or an order block. We had another valid demand zone over here. Now, comment down below which ones you think is a standard order block or a standard supply and demand zone, and which one is the institutional level. The easiest way to identify that is to bring back your rules. So number one, did it create a boss or change of character? Number two, is it unmitigated? Number three, does it have an LQ buildup? Number four, did it create the fair value gap or inefficient push? And all you do is you run through each and every supply and demand zone through your checklist. So let's go through the first one, this demand zone over here. We can actually add a fifth rule to this list. Is it in discount areas of pricing? This one isn't as important, but S&D zones that is in discounted areas of pricing do have a higher probability of sweeping supply and demand in premium areas of pricing to mitigate the institutional level that is sitting in discount. Okay, so we'll leave this here for now. Mainly focus on 1, 2, 3, and 4. The fifth one is really just an extra confluence. Okay, so let's continue with our first demand zone over here. Did it create a break of structure? Well, this is the demand zone that created that daily break of structure to the upside. So we had that previous break, that pullback into previous institutional level and demand. We then mitigated that, swept liquidity to then create that new break of structure to the upside. So yes, this demand zone did indeed create a break of structure. Is it unmitigated? Well, at the time, if I move back price to, let's say, this point in time, we've created that break of structure, which we've got marked out. Is this zone unmitigated? Yes, it's unmitigated because price has not tapped into the zone before. So yes, that point number 2 is checked. Does it have a liquidity buildup? Well, we have 1, 2, 3, 4, an entire support line over here creating 4 taps liquidity, so a quadruple bottom liquidity, which, yes, is resting liquidity above the zone to sweep, which is good confluence, which is another point that makes this an institutional level. So yes, it has a liquidity buildup. Did it create a fair value gap or inefficient push? Well, over here, if you've already watched the fair value gap video in this mentorship, you'll see that we have a valid fair value gap lying over here. So yes, this has a valid, inefficient, and fair value gap push. And then fifthly, an extra confluence. If we take our fib tool from the low to the high of the swing range, we have premium, equilibrium, and discount. This demand zone is in discount. So yes, that is an extra confluence. This is a high probability institutional level. Okay, so then we can recap this and we move on to zone number 1. We can move on to zone number 2. Okay, so having a look at this zone over here, did this zone create a daily break of structure? Because remember, we're using the daily time frame as our example. Well, yes, it did create these little fractal breaks of structures to the upside. But remember, a swing break of structure is the strongest form of structure that you can get. After a swing break of structure, internal structure complements the swing, and fractal complements the internal. My private members watching this video will understand exactly what I'm talking about. So fractal is the weakest type of structure, internal complements the swing, and swing is the strongest type of structure. So yes, this demand zone created a fractal break of structure, but fractal structure is a very aggressive way of approaching structure. Did this demand zone create a swing break of structure? No, it didn't, because this break of structure already happened when this demand zone formed. Point number one isn't valid. Is the zone unmitigated? Well, you could say at this point in time, the zone was unmitigated. So yes, at the time it formed, it was unmitigated, and it just mitigated later on. Does it have the liquidity buildup? Well, we have inducement sitting above the zone. So yes, indeed, it does have a liquidity buildup. Did it create a fair value gap push? Well, if you look carefully, these wicks of candle number 1, 2, and 3 are not overlapping, and we do indeed have a valid fair value gap. So yes, it's created an inefficient push. Is it in discounted areas of pricing? Well, at this point in time, if you had to mark out the swing range from the high to the low, this zone is still in premium. So keeping that in mind, there is good possibility that price could mitigate this zone, get a bit of a reaction, fail and sweep the zone to mitigate institutional levels in discounted areas of pricing, to then continue to target those relative weak highs. Okay, so yeah, simply because this zone, let's just remark out these, this zone has all 4 criteria, simply because this zone only has 3 valid criteria. It is not an institutional level, and it does not validate as an institutional level. Instead, this is just a standard order block or supply or demand zone, which will have a lower probability of running price in terms of swing structure than the lower down institutional level. Okay, so as we let price play out, you'll see that zone gets violated, we mitigate discount, sweep liquidity into the institutional level, and continue price from there. So let's leave price over here, where it is from now, and we'll continue with these supply zones and go over these examples. Okay, I'm just quickly removing these Koki pens. And all you do is, you go and apply, and you run through these 5 criteria on the next zone that you want to mark out. So in a nutshell, you can mark out any supply or demand zone or order block, whatever you want to call it. In order to identify that as a high probability institutional level, just apply these 5 criteria to those zones. So let's go over the example of the supply zone. All right. So keep in mind, we've now had that daily break of structure. We've got our daily strong protected low over here and our daily weak high. So in terms of swing structure, did the supply zone create a break of structure or a change of character? Well, at this point in time where price is currently lying, understanding our structural context, we've had the daily breaks of structures to the upside, strong protected lows are in play, meaning demand is currently in control. This supply zone did not take out the previous strong protected low, therefore it has not created a break of structure. And this is the mistake that a lot of traders make, because they will see, yes, the supply zone created this change of character, it's got the resting liquidity, it's created the displacement fair value gap, but understanding your swing structural context, this supply zone has not created a break of structure. So there is good probability, and also because these highs are weak, price is rather instead going to target these weak highs. So no, the supply zone has not created a break of structure. Is it unmitigated? Yes, it's unmitigated because price hasn't previously tapped into the zone. So yes, that's a checkpoint. Does it have a liquidity buildup? Well, we do have resting liquidity sitting above the zone. So yes, it has a valid liquidity buildup. Did it create a fair value gap push? Well, the wick and the low of the first candle and the high of the third candle is not overlapping. So therefore, we do have a valid fair value gap. Is it in discounted areas of pricing? Well, if we take from the high to that low, we have premium, equilibrium, and discount. Keep in mind, because this is a bear example, all that switches is your discount is now at the bottom and your premium is at the top. So if we mark out the high to the low in a bullish market, this becomes discount, the low becomes your discount, the high becomes your premium. Okay, so yes, the supply zone is in discounted areas of pricing, but simply because the supply zone has not created a break of structure or a change of character and is missing one of our criteria, this is not a valid institutional level. So therefore you'll find also, simply because these highs are weak, looking for shorts of supply would be counter trend, the supply zone is most likely going to fail. We'll have a reaction creating more liquidity, we then fail that supply, creating that new break of structure to the upside. Alright, so the main thing that I want you to take away from today's video is the difference between a standard order block, supply or demand zone, and a high probability institutional level. Now this applies on all time frames. This applies on the daily. So from our daily structure, we can have a look at our 4-hour structure. Okay, so most recently we have had our 4-hour break of structure to the upside, 4-hour strong protected lows, and our 4-hour weak highs. We have valid areas of demand sitting here, and we also have more extreme areas of demand sitting down here. Okay, so again, both of these demand zones, you want to apply your 5 rules that make an order block or a supply and demand zone a high probability institutional level. Okay, so let's go over, we also had a valid demand zone over here. And we repeat this on our 3 structure types. As I've discussed in previous videos in this mentorship, remember mechanically we go from the daily to the 4-hour, which is our daily internal, and from the 4-hour to the M15, which is our 4-hour internal. Okay, so on the example of this 4-hour time frame, let's start at demand zone number 1. Did it create a break of structure or change of character? Well, the 4-hour break of structure happened at this weak high with this candle body closure. So this demand zone formed after that break of structure. So therefore, this zone did not create the original 4-hour swing break of structure. So therefore, point number 1 does not apply. So immediately, I know that this is not an institutional level. This is just a standard order block or supply and demand zone. Yes, it's unmitigated. It did not have a liquidity buildup. Price just moved up and pulled back into it very aggressively, so it did not have the liquidity buildup. Yes, it created the fair value gap push, and no, it wasn't in discounted areas of pricing, as if we mark out our premium, equilibrium, and discount, the zone was in premium areas of pricing. So there was a very good probability that price would sweep this and rather mitigate more discounted areas of pricing before continuing long. Therefore, we know already demand zone number 1 is not a valid institutional level. So if we go for zone number 2, did it create the break of structure or the change of character? Well, the swing break of structure to the upside happened at this weak high with this candle body closure. Yes, this demand zone is within that swing range and created that break of structure. So yes, it did. So therefore, checkpoint number 1 is valid. Is it unmitigated? Well, at this point in time, after the break of structure, yes, it was unmitigated. Price did not pull back and mitigate the zone previously. So yes, point number 2 is valid. Point number 3, does the zone have a valid liquidity buildup? Well, we do have valid inducements and a demand zone sitting in premium above the zone. So yes, we do therefore have valid liquidity for this zone. So yes, checkpoint number 3 applies. Did it create a fair value gap or inefficient push? Well, candle number 1 and candle number 3, the wicks aren't overlapping, therefore we have a valid inefficient push. So immediately, simply because this zone has all 4 of our institutional level criteria, this is a valid institutional level. And ultimately, as an extra confluence, is it in discounted areas of pricing? Well, if we mark out the low to the high of the entire 4-hour swing range, we have premium, equilibrium, and discount. And yes, it's sitting in discount. So there is good probability that this zone can indeed hold. And over here as well, this zone also has created the break of structure. Inefficient push is unmitigated, created the break of structure, and is also in discounted areas of pricing. So we, in this example, have 2 valid institutional levels. So what would you do in this scenario? Well, because this is the 4-hour time frame, we automatically hop over to the M15. So whichever zone gives confirmation first, for example, if price on the M15 gives that break of structure to the upside, we can start looking for longs to target those weak highs. So let's take a look what price happens. Okay, so we mitigate this zone, we can hop over to the M15 and continue with our M15 structure. So here on the M15, price is now mitigated this higher time frame 4-hour institutional level. So what we want to see is structure to start shifting bullish, putting demand in control to then look for entry confirmation. Okay, so let's let price play out a little bit. We haven't had really any structure form after the mitigation into this order block. Take note of how I don't look at previous structure. This is old price action. I want to see what price does in this institutional level. Okay, so over here we're having a little bit of structure form. What I would like to see in order for me to enter and look for long positions is I want to see these highs going to the upside. So I can start to mark out my strong protected lows, weak highs, and my context on the M15 time frame. Okay, so there we go. We've now had that candle body closure with a demand zone in control over here and another more extreme demand zone down here. So that becomes our M15 break of structure. This becomes our M15 strong low. So would it be valid on the M15 time frame? And again, on the M15, if we bring back our institutional level criteria, I just need to fetch that from the 4-hour, make that available on the minutes chart. We apply our criteria. Okay. So let's go over zone number 1. Zone number 1, zone number 2. Is zone number 1 creates a break of structure? Well, we had our M15 break at that weak high. The zone formed before that break of structure. So yes, it did create a break of structure. Is it unmitigated? Price has not pulled back into the zone and fulfilled orders in this level, so therefore it's unmitigated. Does it have a liquidity buildup? Well, as price lies, there is no liquidity buildup currently, but you can let price play out a little bit. And that's ultimately what we want to see. We do now have that inducement sitting above the zone, so yes, it has a valid liquidity buildup. Did it create an inefficient push? Well, we do have candle number 1, 2, and 3 not overlapping, therefore there is a valid fair value gap sitting above the zone. So immediately, all 4 of these criteria are checked, therefore this is a valid institutional zone. And as an extra confluence, is it in discounted areas of pricing? Well, if I mark out the high to the low, the majority of the zone is sitting in premium discount. So keep in mind, there is the probability that price could sweep the zone, rather mitigate institutional levels in discounted areas of pricing before continuing long. In this scenario, you could look for longs at this zone with your stop below the low just to cover the discount, and also at the more discount to target those relative 4-hour weak highs. Okay, so let's see how price plays out and what we mitigate first. Okay, so in this scenario, we mitigated the recent zone, which actually did eventually end up becoming in discounted areas of pricing. So both of these zones would have been 100% valid. And what you can do is to tighten your risk to reward, which we will discuss in later videos of this course, is entry confirmations. So within here, you can look to refine and tighten your stop loss to ultimately get that tighter risk to reward. Okay, so let's let this play out and see what happens. So price just following structure, M15 break, pullback into discount demand to continue targeting those weak highs. All right, pullback into discount demand, targeting those weak highs. Pullback into discount command. To continue, targeting those weak highs, just following your structural context off the higher time frame institutional level. Okay, break of structure, we can expect a bit of a pullback. To continue, mitigating discount demand. All right, larger pullback into discounted areas of demand. To continue, targeting those M15 weak highs. M15 weak high and that 4-hour weak high has now been targeted as per our structural context on the M15, our 4-hour and our daily time frame. And this is the difference between trading standard order blocks and higher probability institutional levels with the idea of your structural story and context of the market. Alright guys, if you have any questions on today's video, please do send me a message on Instagram. I'm very active with my members and also my audience that I'm busy mentoring over here for free on YouTube. Please don't be afraid to send me a message. If you want to join my morning markup live streams every single morning, going into session, marking up the full contextual story of price action, giving each and every member that clear crystal understanding of exactly what they can expect from price going into session, forming my trade plan and executing that trade plan. I will leave a link down below. I will also leave a link down below to more of my full in-depth, you could say, secret sauce for my private members inside of the Discord, which is hundreds of hours of webinars, more in-depth course content. I will leave that link down below. Take care guys, and I'll see you in the next MMFunded ICT 2024 mentorship video tomorrow.